Bonds. In this video, we'll look at bonds and how you can use them in a safe way to manage your investment income. As a general definition, bonds are debt securities issued by a company, organization, or government to raise capital. Companies can obtain debt financing from a bank in the form of a loan, but in some cases, they issue bonds to investors to raise this capital. Bond financing is often less expensive than raising money through equity, and in most cases does not mean that the company must give up any control or power. So for them, it's a strong option for raising funds. When you decide to invest by purchasing a bond, you are essentially lending money to the issuer in exchange for regular interest payments and the eventual repayment of the principal amount at a specified future date. It looks a little like this. Money is lent greater than interest repayment, plus some capital multiplied by length of the term equals full repayment plus interest. Bonds typically have a fixed interest rate or coupon rate, which is the amount of interest paid to the bondholder at regular intervals, such as semi-annually or annually. The bond's term, or the length of time until the bond matures and the principal is repaid, can range from a few months to several decades. So in theory, if you pick the correct bond option, you can realize investment potential for years to come. Bonds are generally considered to be less risky than stocks because they offer a guaranteed rate of return and a predictable income stream, but they typically have lower returns than stocks over the long term. So when you're assessing if bonds are the correct option for you, it's important to revisit your strategy and understand why you are investing. Is it long-term gain and low risk, or short-term wins and high risk? Bond prices can also be affected by changes in interest rates, inflation, and credit ratings of the issuer. And, as with anything, your money is never truly safe because bonds have been known to fail. In some cases, bonds have failed or defaulted when the issuer has been unable or unwilling to make interest payments or repay the principal amount to bondholders. This can happen for a variety of reasons, such as financial distress, bankruptcy, or political instability. So, although it's a safer option, it's not foolproof. Typically, when a bond defaults, the issuer may be forced to declare bankruptcy or restructure its debt, which can lead to losses for those who hold bonds in the organization. And those that have these bonds may receive only a fraction of their investment back, or they may not receive any repayment at all. In addition to default risk, bonds can also be subject to other types of risks, such as interest rate risk, inflation risk, and credit rating risk. These are the elements mentioned briefly earlier that can affect bond prices, and as such, each has its own potential impact on your bonds. Interest rate risk often refers to the risk that bond prices will fall if interest rates rise. Inflation risk is a little more complex. It refers to the risk that inflation can have in eroding the purchasing power of the bond's returns. This means that if the rate of inflation is higher than the rate of return on the bond, the real value of the returns will decrease over time. Generally, this is because a higher or rising inflation rate will cause the price of goods and services to rise, resulting in the same amount of money being able to buy fewer goods and services in the future, lessening the value of your bond. Finally, credit rating risk refers to a risk that is found when the issuer experiences a decline in its creditworthiness. The potential downgrade in a credit rating will mean there is less confidence in the organization, and hence there will be a fall in the bond's value. If you think bonds are the right option for you, you can purchase them through a broker, a bond mutual fund, an ETF, or directly from the US government. Whatever you do, make sure that before you buy, you check the bond's rating and learn about its financial health. Don't get caught short or go in without taking due diligence. And finally, don't forget that buying and holding bonds to maturity is one strategy for investing, but another can be to sell early and make a profit.